Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all to today's 143rd CP program organized by AASB of ICI this year. Today we are organizing 143rd program for this council year. As we all are aware that AASB has covered all the sectors-wise audit consideration as well as covered all the auditing standards also. Today, again, very important topic relating to auditing, that is the internal financial control over financial reporting. And in order to tackle this very important topic, we are having with us our very learned speaker, C. Amit Garg. So on behalf of AASB of ICI, I extend warm welcome to you, Amit ji, on this AASB platform on Zoom. We are also having with us very learned and very respected CA Vikram Agarwal ji. So I extend warm welcome to you, Vikram ji, to give your kind consent to moderate today's webinar. So Honorable Chairman Sir as well as Vice Chairman Sir both are stuck up in meeting. Maybe in couple of minutes, Honorable Chairman Sir will join. So before Sir's joining, may I request today's moderator of the webinar, CA Vikram Agarwal ji, to please start the proceedings of the today's webinar. Over to you, Vikram ji, please.
Thank you, Anil ji. Thank you. Thanks a lot. Good evening, friends. On behalf of the ICI, I welcome all of you on this webinar on internal control and financial reporting. As we all aware that ICI is always keen to empower its member to deal with the rising challenge, either in terms of business environment, technology. As an auditor, is need to be more vigilant in terms of documentation and audit technology also. And ISFR audit generally conducted listed companies, but this year there are a lot of IPOs, SMEs, and this sector is going to be grow rapidly. ICFIR is basically presently in listed company only. This ISFAR is opening opportunity for small and medium practitioner also due to this SMEs listing also. Today we have a very distinguished speaker with us, Amit Garg, who is having a very vast knowledge on this topic, ICFAR. First of all, I like to read his brief profile because his profile is too big and we don't want to waste much of time to read his profile. So this brief profile is Mr. Amit Garg is a part of assurance team based in New Delhi. He has over 17 years experience of consulting, process design, audit and varied industrial sectors. Amit is currently into his own practice and lead assurance division at its firm R&BP and Company. Prior to this, Amit has worked with E&Y for 12 years in statutory audit practice. He specializes in process review, control design, testing, internal audit, statutory audit, IFRS, Ind AS, implementation and due diligence. He has a very good project management skills, having lead large project which involve multidisciplinary teams and work against tight deadlines. Amit is also faculty of IFRS and Ind AS course conducted by the ICAI, Delhi University Business Management course. In addition to this, Amit is also experienced in handling capital market transactions. So now I request Mr. Amit ji to kindly enlighten our members about this IFRS. Thank you. Amit ji, over to you.
Thank you, Vikram bhai. Thank you, Anil ji. And thank you, Chairman and Vice Chairman, sir, for providing me this opportunity to interact with such a large and august audience. And as Anil ji said that this is the first 143rd session. It's a remarkable achievement that earlier we used to hear that there are webinars or seminars or physical meetings on tax or indirect taxes or direct taxes. But now sessions are happening and so frequently on audit. It's really a great achievement, Anil ji. And as you said that there is a large audience also on who has joined. So it means there is a great interest. So I welcome you all for this webinar or on audit of internal financial controls. So now without wasting the time, let's deep dive into the technical part, as we have very less time. So it's a seminar for 2 hours and we have to cover a lot. So starting with agenda, so we will discuss first what is the global scenario. Anil, just before going forward, my screen is visible to all now. Anil, can you please confirm my screen is visible?
Yes, sir. Yes, sir. Visible, sir. Fine, sir.
Thank you. So we will start with the global scenario and then we will understand what is the regulatory framework in India and what is the scope for ICFR audit as far as statutory auditor is concerned. then we will understand the definition of IFC. IFC is the internal financial control, which is given in the Companies Act. Definition is well defined in the Companies Act itself and then has been elaborated in guidance note issued by ICI as well. We'll discuss planning and approach for ICFR audit. Now, then the part of a review of IT general controls, review of business process controls, and validation of IPE. IPE is very, very important topic. We'll just discuss something about it, and we are dealing day in, day out with the IP, information produced by entity. So we will discuss going forward. So let's move on with the global scenario and mandate in India. What is the global scenario and where is the origin from where this is coming? The mandatory requirement of audit on ICFR is required. So basically, as we know that there were huge collapse of the corporates in US sometime in 2000. So post that, government felt the need that something should be done, and then in 2002, an act was passed. The name is Sarbanes-Oxley Act 2002, which was passed, and this is a federal act in US. And as per the section 404 of Sarbanes-Oxley Act, which mandates the public company auditors to certify the internal controls over financial reporting. And on the requirement as that is coming from the act, so the PCOB, which is the Public Company Accounting Oversight Board in US, regulates the kind of profession, and that has issued the auditing standard, which is AS5, and the name is an audit of internal control over financial reporting that is integrated with an audit of financial statements. Means they have given a detailed guidance in auditing standard 5, what is required, how it is to be done, how the planning is required, what all concepts, what is the framework, everything is very, very detailed guidance is given in AS5, which has been notified. And since then, the uh, certification by the auditor is required in US. And following the trend of US, then in 2006, Japan also passed the similar kind of legislation and made the audit of ICFR mandatory. And various other companies in the globe have been following the same trend, and there is a requirement of audit on internal control over financial reporting. So, with this background, in 2000, so new act was applicable, and the Companies Act 2013 was notified. And in the Companies Act 2013, it was required that auditors of the company are required to comment on the ICFR also. ICFR is internal control over financial reporting. So we'll discuss there is a difference between IFC, internal financial control, and internal control over financial reporting, or internal control with respect to financial reporting. There is a gap between the two. We will understand that as well. So as of now, the mandatory requirement in India is coming from Companies Act 2013, and in September 2015, the ICI came up with an excellent guidance, which is guidance note on audit of internal financial control. And this guidance note contains pages of 320 and discuss each and every aspect relating to the audit of ICFR. Very, very detailed and beautiful publication by Institute. And earlier, this requirement means the audit of ICFR was made mandatory for the financial year 14-15, but there was no detailed guidance. So, post that, Institute came up with this guidance note, and then it was made mandatory from financial year 15-16 that every auditor is required to give the opinion on internal control over financial statement, or internal control over financial reporting as well. So if we talk about today, this requirement is mandatory. Auditor of a company is required to give his opinion on internal control over financial reporting along with the audit report on financial statements. So here we are giving two audit reports. One is on ICFR, other is on financial statements. And this audit is called integrated audit, wherein we are giving the opinion on control as well as on financial statements. So what do you mean by means it is coming, the requirement is coming from 15-16. Prior to that, we were not doing any control testing? No, it's a long story. It's way back we have been doing, control testing. Even your uh, auditing standard, which is 330, talks about that you have to uh, devise the, your procedure that they talk about test of controls and substantive procedure. This test of control is nothing but your reliance on the control. Yes, earlier that the standard was made applicable in 2008. However, there was no separate requirement at that point in time to give a opinion separately, but who was performing a control testing for your main audit report, and main audit report was on financial statement. But the history is long, and control testing was required since AZ. But now, from 1516 onwards, Companies Act made it mandatory for the auditor to comment on the ICFR also. Now let's understand where is this requirement. First, let's discuss director responsibility statement. So section 134(5) clause E of Companies Act talks about the responsibility of the directors regarding the financial internal control. Now, this section talks about internal financial controls, and especially this director responsibility statement is mandatory for listed companies. And in case of listed companies, the directors have to give statement in the director responsibility statement saying that the directors have ensured that they have laid down internal financial controls, and such financial controls are adequate and operating effectively. So we are talking about two aspects. One is adequate and other is operating effectiveness. So in case of a listed company, even the onus is very, very high on the management also, on the director also. They have to ensure the system is in place and that is adequate. Adequate means in terms of sufficiency, there are effective controls, and those controls are also operating effectively. It's not like that you have made the control, but that is not working. But just for the sake of documentation, that control has been designed, but that is not operating. No, in case of listed company, they have to test it also. Management also have to test in the similar way the auditor is doing. The auditor is doing the testing, and they are giving the opinion. In the similar way, they will test and they will disclose it in the director responsibility statement. But what about non-listed companies? So there is a separate requirement that is in there in Rule 8, Sub Rule 5 of Companies Accounts Rule 2014. It says that the board of directors has to specify in their board report that there are adequate controls with reference to financial statement. But there is a slight difference. Here the scope is very, very wide. Talks about internal financial controls, but here they are saying adequacy of the controls with reference to financial statements only. So basically, indirectly they are covering the operating effectiveness, but not directly they are specifying, because until and unless you will ensure that the controls are working, how you will ensure that their adequacy is there. So, but in a black and white, all the companies, irrespective of the size of the board of directors, have to write in the board report that there are sufficient controls with respect to financial statements, be listed, unlisted, all companies. Now come to the requirement of the auditor. Now, under section 143, subsection 3, clause I of the Companies Act 2013, it mandates the auditor that you have to mean the auditor have to issue a separate report on the audit of internal control over financial reporting. So audit of ICFR. Now, as you must be dealing or you must be giving opinion, so you have seen that there is a separate report on ICFR as well. So what does this mean? It is mandatory for all the means the auditor. Yes, definitely board have to disclose it in the board report that controls are there. But what about the position of the auditor? That they have to audit ICFR for all the companies? No, because when it was notified, there was no exception. But subsequently, company went to the MCA and they said that there are small companies which cannot mean definitely there has to be cost benefit analysis. So small companies were not in a position to spend such an amount and meeting all the requirements. So then there was a circular and it exempted. There was a notification. It exempted certain companies from the audit of ICFR. And what are those companies? One person company, first exception. Second exception, small companies. So small company is also defined under Companies Act. Then third is the private company who is having the turnover of less than 50 crore as per the latest audited financial statement. And it's not or, please mind it, and it is not having borrowings 25 crore or more during the financial year. It's not as of the previous or the latest during the financial year. If I summarize, one person company, small company, private company having turnover less than 50 crore or and borrowing from financial institutions or bank less than 25 crore during the year. If this criteria is fulfilled, those companies are not required to get their ICFR audited from the statutory auditors. Other than this, all companies are required mandatorily to get the auditor's opinion on ICFR under section 143, subsection 3 and clause I. Now, auditors reporting on internal financial control will apply only in case of reporting of financial statement. What do you mean by this? Because there are various types of audit. There may be a special purpose audit, there may be interim audit, there may be, uh, suppose companies coming into IPO, there may be a special requirement. No, the act is very, very clear. The requirement is very, very clear. If the statutory auditor is giving the opinion as per the Companies Act, means as per section 129, subsection 4, the company is required to present their account and that has to be audited. So only that requirement means if that is coming from the Companies Act, only then auditor is required to give the opinion on ICFR until and unless there is any separate requirement of any other act. But under Companies Act, this is the requirement. We have discussed that on interim financial statements, ICFR is audit of ICFR is not applicable. So only on yearly audit it is applicable. That too, which is coming from Companies Act. Now, the question comes whether it is applicable for consolidated companies also, on consolidation also. Yes, as section 129 says, the all provisions which applies to standalone Mutandis applies to holding company also. So holding company is issuing standalone financial statement, they are issuing consolidated financial statements. ICFR, audit of ICFR is applicable on both the audits, provided this ICFR aspect will be covered only the companies which is getting consolidated in the consolidated financial statements, which as per definition under Companies Act is defined as the company. So if there is a suppose trust or there is a LLP or there is a firm, if that is getting consolidated, so this ICFR will not applicable to that component. But as such, on an overall basis, ICFR audit is applicable on the consolidated financial statements, and the auditor can rely on the reports of the component auditor, and accordingly they can comment on the ICFR. It's not necessary the holding company auditor has to perform the ICFR audit for all the components. Okay, now very, very important part. As the control is operating throughout the year, right? control is operating throughout the year.
Right.
But auditor has to give opinion of the controls which is adequate and operating effectively as on the balance sheet date. That's a very, very comforting position for the auditor at least, right? But what do you mean by this? If you have to give the opinion as of the balance sheet date, though it is not defined in the Companies Act, but if there is an analogy, because in earlier Caro 2013, they were asking whether controls are effective for and fixed assets or sale of goods or services. And if that has been remediated, that you have to explain. So the analogy is that the control should be adequate and operating effectively as at the balance sheet date. And this has been clearly defined in the guidance note as well. And similar position also applies in US, Japan, which we have discussed in the global situation also. We have to give the opinion as of the balance sheet date. So what does this mean? We are not required to perform control testing during the year. No, because it is not possible for us to verify, perform control testing as on the balance sheet date. We have to perform control testing during the year, means at an interim date. And this is the right time. The session is happening at the right time in December. And if we talk about audit of 23-24, so the interim period you can consider 9 months, that is up to December. So in January or February, you can perform control testing on 9 months period. And but we have to give the report as of balance sheet date, means as of balance sheet date will be 31st March 2024. So what we do for the remaining period? So now the concept comes roll forward testing. So roll forward. So we have performed testing, control testing on 9 months period. Whatever conclusions we have derived, we will carry forward to the balance sheet date. And for the remaining period, 3 months, we will perform certain procedures and we will ensure that there is no new system, there is no new control, there is no change in system, and there is no significant risk arising in subsequent periods. So all those things we have to see, and depending on the nature of the organization and size of the organization, we can decide our roll forward procedures. It may be inquiry procedures, it may be like testing of additional one sample during that 3 period. There are various combinations in that. So through that you can do your roll forward, you can perform your roll forward procedures for the remaining period. But practically how does it happen? So we do 9 months audit or 9 months audit or 6 months audit on ICFR, and for the remaining period just carry forward those results and perform inquiry procedure verification of certain transaction, not significantly which is required in the normal course of business, but yes, you can select some more samples depending on the remaining period. So that's purely a judgment and what is required. So that depends on various factors, but yes, you have to perform the testing as everything cannot be done on balance sheet date or post balance sheet date. So perform the good policy or good design of control. It should be at the interim date, and then you move forward or you roll forward your procedures for the remaining period. That is called roll forward procedures. Now we have discussed what is the mandatory requirement, to whom it is applicable, why, what is the means origin of these controls. Now let's understand what is IFC, internal financial control. It is very well defined in the Companies Act itself. What the definition says, what the Companies Act says, it says IFC has been defined as the policies and procedures adopted by the company to ensure orderly and efficient conduct of its business. What do you mean by orderly? Means neatly and chronologically, the literal meaning. And efficient means to the maximum productivity. To the maximum
Maximum.
productivity. If I understand the word efficient, it means something relating to the operation of the company. Maybe there may be indirect impact on the financial statement, but there is no direct impact. Because if we talk about that, the main objective of the company is earning profit. How they can maximize the profit? How the management can maximize the profit for the shareholders? So that is how they can run the business efficiently. If I want to buy a product, What I will do, I will ask for the quotations. I will ask for 3 quotations as per the policy. And whatever is the L1 party, provided the technical criteria is met, then I will go for L1 party. So that is kind of an efficient business. So it is something relating to the operation. So to ensure orderly and efficient conduct of this business, including adherence to the company's policies, safeguarding of its assets, prevention and detection of frauds and errors, accuracy and completeness of accounting records, timely preparation of reliable financial information. So basically, this definition is for IFC, Internal Financial Control. However, as an auditor, I don't have to perform procedures or control testing for everything. I have to perform control testing, which is pertaining to accuracy and completeness of the accounting records and timely preparation of the reliable information. So this definition is for all aspects. It covers all aspects of the operation, control, and compliance. So if we break down this definition, so it says the policy and procedure adopted by the company for ensuring orderly and efficient conduct of its business for adherence to the company's policies, safeguarding of assets, prevention and detection. So this is something relating to operation. And then accuracy and completeness of the
Accounting
records
records.
and timely preparation of reliable financial information. So basically, if I give you difference between IFC and ICFR, so these together, these together, if I talk about this together is IFC. But if I talk about only this portion, this is ICFR.
I see.
And I have to, as an auditor, I have to give opinion on this part only. Means controls pertaining to this that should be adequate and should be operating effectiveness on this part. This is the difference between IFC and ICFR. And as we discussed initially, that in case of a listed company, management has to devise the internal control system, and they have to test also, and they have to declare in the director's responsibility report. Okay, so there are various auditing standards which guides us, which helps us. So there is SA 315, which talks about means identifying and assessing the risk of material misstatement through understanding the entity and its environment. So detailed guidance is there. There is appendix 1 or 2. In appendix, there is a detailed, example of misstatements and how we can, evaluate that. So this is very, very important essay as far as audit of ICFR is concerned. So detailed guidance is there, which talks about how we have to identify and how we have to assess risk of material misstatement. And this word is very, very important. RMM is the risk of material misstatement. We will discuss this word throughout our presentation. Then there is a separate essay 200. The auditor shall comply with essays relevant to the audit. It is mandatory that you have to comply with all the essay. Okay, my question is it mandatory to comply with all the essays? This is only institute is saying, or somebody else is saying that you have to comply with auditing standards? Companies Act, it is mandatory. Definitely institute is saying, but along with that, the authority is coming from the Companies Act, section 143, subsection 10. It says that auditor has to comply with all the essays. So it is mandatory for the auditor also to comply with all essay. It's not optional. Then essay 230 documentation, definitely when we are performing control testing, when we are devising a control strategy, so all documentation should be done. A golden rule which is there for documentation is work not documented, not done. And as you are aware now, NAFRA, as everyone means, if you hear the word of NAFRA, National Financial Reporting Authority. So if you do whatever work you want to do, if you are not writing it, then you have done nothing. You spent the whole lot of nights, days. You are doing very good audit, But if you are not documented, and we are lacking in that, let me practically accept this fact that we as a auditor do lot of work, but the problem with us is that we don't document that. And but my personal advice that you do limited work, you don't do over audit. I will not advise you do over audit, but whatever audit you are doing, whatever is the requirement, write it in. There is no specific format also how you have to write it. Like whatever work you have done in the Excel, at the below write work done, just simple write work done, and what you obtain the dump or the general ledger of the entity. You counted total line item, you selected sample every 15th line item, or every 20th line item you selected. Whatever you have done, just write in bullet points, it will work. And at the end of that work done, then conclusion, you write the conclusion also. Then you can say amounts are fairly stated, you have not come across with exception, and if exception is there, deficiency is there, right? Whatever deficiency is there, and how you have concluded that, how you dealt with it, because ultimately you have to issue the audit report. Then how you will issue the audit report? It is important that you have to conclude that. No hard and fast, no specific format. In whatever format, whatever Excel, Word, PPT, whatever you want to use, but write what you are doing. This is very, very important. Do limited audit. Again, I am saying do limited, but write whatever you are doing. Very, very important. This is your life saving things. Otherwise, it is getting very, very difficult in today's scenario. Giving an audit opinion is, giving a lot of headache. But if you are following these basic necessities, there is no good, if you ask me, it is giving you a business of 5 years at a time, because now appointment is for 5 years. It's not easy for the management to remove you before 5 years. It is a lengthy process if they want to remove you. So alongside, there is a pros and cons. It's a risky thing, but definitely it's a good thing. I will advise do audit, but do documentation. Okay, coming back to the next point, that is SA 330, overall responses to address the assess risk of material misstatement. So this standard again means that talks about test of controls and test of details. So even before the audit of ICFR, which came into 2016, before that, this standard is applicable since 2008, and it talks about that before, when you give the opinion on the financial statement, you have to perform the test also. That is called, even in earlier days when we were studying, we used to talk about control strategy, substantive approach. This is same thing. If you do perform, if you test controls, and if that is effective, your work significantly reduce for substantive. But if your controls are not effective, then you have to do a lot of work for substantive testing. So from that perspective as well, control testing, any which way we were doing, but now it is mandatory. We have to do it, but leverage, important point is leverage this testing for your audit. If you are not leveraging, then you are ending up doing a over audit. Again, I am saying do whatever is required, use materiality effectively, very, very effectively, and do the required things, but meticulously. Whatever you are doing, do it from the end to end, not just you picked one transaction, some part of that transaction you have verified, and for other transaction, other part you have verified. So if you're picking a transaction, do it from the initiation, authorization, processing, recording till reporting. You have to do end-to-end testing of that particular sample, but do it properly and completely. Okay. So, okay, ICFR audit is mandatory, but why? Earlier, you was giving opinion only on financial statement, but if you pay attention to this, picture, so financial statements, how financial statements are becoming, and what are the components of it. So there are balances, there are receivables, there is payables, there is a fixed assets, there is share capital, whole lot of line items are there, whole lot of disclosures are also there. But that indicates something: completeness, existence, occurrence, rights and obligation, valuation, presentation, and disclosure. These are called assertions. These are management assertions. So if some balance, let's take an example, accounts receivable is coming in the balance sheet. What does this indicate? It is saying that, for example, accounts receivable 1 crore rupees. What does this mean? It means the company has to take 1 crore rupees from the debtors, from the parties, right? But that 1 crore rupees is receivable or not, how you will verify? So there are certain assertions. What are assertions for accounts receivable? Whether that is complete. Why it is 1 crore? It may be 90 lakh, it may be 1 crore 10 lakh. But whether 1 crore is right, it is complete, or whether it has been valued accurately, whether it exists at all, means one crore is whether it is exist or not. So these are the assertions. We have to test those existence, whether that 1 crore exists or not. Maybe lena hi nahi ho. How you will come to know whether this is receivable? As an auditor, you have to perform certain procedures. So you have to perform procedure at assertion level, right? So now coming to the assertions, we have discussed assertion. These are the assertions for each account balance or class of transaction. There are certain assertions. Class of transaction means revenue, expense, account balance, trade receivables, trade payables, property, plant and equipment, disclosures which we give, disclosure, related party, segment. These are all disclosures. So all these have assertions, certain assertions. But now coming down to this, now at this assertion there may be error. There is a risk. That risk we call it a misstatement. What is the risk? This 1 crore does not exist. We don't have to take it, or we have to take only 70 lakh. Management has overstated to 1 crore rupees. So that is the risk. So existence is the risk. Completeness is the risk. So at assertion level, we identify misstatements. So now when we have identified misstatements, we have to identify controls also. We have to controls also. So at this level, there may be a misstatement, or if it is significant, it may be a material misstatement. So mitigate these misstatements. We identify controls, we design controls, we test controls. So at the end, we come to the internal financial control. So mitigating these controls through ICFR, we get comfort on the financial statements. So that's why this is integrated. This is called integrated audit. So earlier we were giving opinion on financial statements, but now we are required on ICFR. But any which way we were doing some kind of procedures, we were performing some kind of control testing earlier also. Okay, so that is integral part. Now this is called integral audit. What do you mean by integral audit? Means you have to give the opinion on internal control over financial reporting, for adequacy. This is very, very important, for adequacy as well as effectiveness. So these two parts. What do you mean by adequacy? Means controls are sufficient. There are sufficient controls which can prevent or detect the error. Error may be due to fraud, or it may be normal error, right? So we have to test both for adequacy as well as effectiveness. So we understand how we do the adequacy test, and how do we do effectiveness test. This is one part. Another is opinion on the financial statements. So we have to give opinion on both the parts. This is called integrated audit or combined audit, right? Therefore, we should design procedure for testing of controls to accomplish both objectives. So audit of financial statement on audit of ICFR. This is called integrated audit. So it doesn't mean only substantive audit. So when there may be a situation when we were not required to give opinion on ICFR, we could have performed only substantive procedures, because there were small companies. The companies were running on some small softwares, so they were not huge systems. So you can directly jump into the substantive procedure approach. But now you have to give opinion on ICFR, so you have to design the controls as well as. Okay. Now important part, as you are issuing 2 audit reports, maybe one audit report is qualified. So is there any possibility that another report is not qualified? Yes, significant deficiency or material weakness in internal financial controls over financial reporting may exist even when financial statements are not material misstated. Materially misstated means there is no significant error which will not impact the decision of the economic users of the financial statements. Right? Now we are testing the controls. Okay, let me just clarify that this is the possibility. When we are talking about controls, it is not actual. We are just trying to achieve there is no possibility of any error. By testing the controls, what we are trying to achieve, there is no possibility of happening any error in the system. Doesn't mean actually it is happening or not. That you will come to know here. By performing substantive procedure, you are just deeping dive and you are verifying it. So there is a possibility that this may be qualified, this report may be qualified, but this report is not qualified. Because if you have, for example, you have found certain error, okay, that error can be corrected. If that is corrected, your financial statement will be corrected. There is no misstatement in the financial statement. So ICFR may be qualified, may be disclaimer, but it's not necessary that your financial statements will be qualified. So it may be unqualified, unmodified also. So this now coming to the components. This is called 5-step approach or 5 components of the control environment. This is given in the guidance note. If you want to set up an effective internal financial controls, so these all activities should be there. So this has been segregated into steps. So first step is control environment. And what it consists of, control environment means, okay, I give you one example first. For example, you are constructing a house, right? If your house is being constructed, your lintel is very, good qualities, 9-inch, 11-inch, 12-inch, as thick, and you have used very good kind of cement. So your lintel is good, good saria, good steel you have used. Walls are very, very strong. Good cement you have used. Good bricks you have used. So what you are trying to say? If the people who are coming to stay in the house will feel safe, right? The house is earthproof, waterproof, right? So if overall environment is good, so the things working under that environment will is deemed, may or may not, but it can be assumed that that is working effectively and you can rely on that. So if my house is very good construction, I can safely rely stay in that, saying that even earthquake is there, I can feel safe. House will not fall, right? So in the similar way, if we talk about the control environment, if at the top the people means the management is has high values, ethical values are very, very high, like there is a code of conduct, good policies there which has been set at the top, and that has been circulated in the organization, and every employee who is joining the organization has to sign that code of conduct. So highly and the management is very committed that they will hire a competent people. So if you are hiring a competent people, definitely the results will be good below the line. Participation by those charged with corporate governance, means audit committee, board of directors are reviewing on regular basis, like uh, comparison analysis of budget versus actual. Whistleblower policy is there. So meaning thereby even the management is also actively participating. Philosophy or the operating style of the management, whether management is taking very aggressive policies or very aggressive accounting positions, very aggressive accounting policies they are adopting. So it sets the tone. It says you get the sense whether what you will find below or at the ground level. So that's why it says first and check the environment, and there in environment there may be good human resource policies. What is the authority? What is the segregation of duties? Organization structure? All this you have to see in the controlled environment. Then second is the risk assessment. What is the risk assessment? Risk assessment means what is the kind of system they have placed, means the management has placed in the organization, and what is the likelihood, of occurrence of misstatement. And if even if occurrence means the error has happened, error or some mistake has been committed, what is the what is the detective control? If some fraud has happened, some mistake has happened, how you will rectify those controls? Let's take an example, another with real life. When you go out of your house, what do? You put a lock in the house. Why you are putting a lock? What is the risk? The risk is that a thief can enter in the house and can steal the things. That's why you are putting the lock. So here risk is stealing the things from the house. And what is the control? Putting the lock. And putting the lock is a preventive control. Prevent kar raha hai, means it is preventing from happening of non happening of the stealing. But along with that, there is a CCTVs also. You have put the lock, but outside, inside house, there is a CCTV cameras also. And even in the colony where you are staying, or in the society where you are staying, there is in the colony also there are CCTV. There is a gate also. At the gate, there is a guard. There is a CCTV. What is that? So that is the control. That is detective control. If somehow lock has been broken, things has been stolen, so you can identify how the thief means how the thief came, how he has stolen, from where he has gone. So kind of, so there has to be a mix control, there have to be a preventive control, there have to be a detective controls. Now coming to the organization, there is a inventory. If you enter in a retail shop, maybe any Reliance or any Adidas or any, you can go enter into a retail shop. But you see, when you pick up any cloth, there is certain machines, or there is a device which is removed from the cloth and then it is given. So if that is not removed, then again at the gate there are electronic machines which is installed at the gate. As you go outside the gate, and if you have not done the billing, then immediately the beep will pop up or ring over there. It will be identified. So these are the preventive controls at the gate. There is a preventive controls, so nobody can steal the things, nobody can go without billing. This is preventive. And detective, every month, every week, physical stock count is done. Every week, or that depending on the policy of the company, or every month, physical verification is done to ensure whatever stock is there in the books, whether that is there on the ground or not. If that there is a gap, what is that? Though it will not bring back, but they can identify. So it's kind of a detective, but it will not correct, because if something has been stolen, then it is stolen. But that is a detective control. Okay, detect ho jayega means what is the amount of the things which has been stolen. So basically what we are trying to say in the risk assessment, you understand the objective of the company, identify the assertions, identify the significant accounts, identify their assertions, and add those assertions, identify what kind of risk may happen. For example, in case of a revenue, there may be a overstatement of revenue. How? Then what is the control for overstatement? Cut-off procedures. Maybe you have billed before 31st March, but goods have reached after 31st March. And the Incoterms means delivery terms is like you have to deliver at the customer premise. So until and unless you deliver at the customer price, till that point in time, it is your goods. You cannot recognize sale. So by performing cut-off procedures, you can plug the risk, or you can address the risk. So cut-off procedure is a control. Then overstatement is a risk. Then control activity. Control activity, we have discussed that whatever risk we have identified, so you have to develop certain controls to address those risks. We have discussed the risk. Oh, okay, let's take another example of control and risk. Payables. Again, there is a payables, whether it is complete, whether it exists. So you can ask for direct confirmation. There is again separate essay on direct confirmation. So obtain direct confirmation from the vendors, then you will come to know whether it is complete. Means if it is not complete, there may be a situation like cut-off procedures. Again, here it will come into picture. And what is the amount? If that matches, then it is fine. It exists and ensure completeness. But if it is not matching, maybe certain transaction has not been recorded by the company. Certain goods they have purchased, maybe that has not reached. They have not booked that purchase, provided their risk has started from the vendor's factory. So you have to identify controls at the third step to address the risk which you have done at second point. Then communication. What kind of information systems you are using internally, externally. Then performing the monitoring activities, means somebody is reviewing, means controls are happening, but who is reviewing that? For example, BRS, bank reconciliation statements. Maybe finance controller every month reviews the bank reconciliation statements, which is being prepared by the accounts manager. So that is monitoring activities. And during that activities in monitoring, maybe the finance controller may identify certain deficiencies and communicating those deficiencies to the management and addressing those, or maybe identifying certain compensating controls to plug those deficiencies. Okay, so this is the overall structure which has been given in the guidance note of the ICAI. Now coming to the planning part. So what exactly we have to do when we are planning the control procedures, designing of the control, assessing the risk, and deciding the control to test. So following consideration must be, you should observe or you should understand. First, what is the nature of industry where the company is working? Nature of industry. If you are working in, for example, in defense manufacturing equipments, it is highly regulated company, highly regulated industry. If you are working in electronic industry, so there may be repercussions on discarding or managing the waste, plastic waste or electronic waste. The company operates in complexity, maybe complexity like as we discussed, the highly regulated, highly complex manufacturing structure. Suppose Pepsi, you talk about manufacturing of Pepsi, so complex. Maybe there may be complex formula for making that Pepsi or Coca-Cola or something, all other drinks. Then companies, business, including organization, how the organization structure is, means at the top management is there, whether below that there is a functional head or directly managing director is reviewing the work of finance controller or accounting manager. So it gives you certain factors or the points how you have to design. If there is a proper structure, means there is a managing director, there is a CFO, then below CFO there are functional heads, below functional head there is a appropriate team is competent. So it gives you comfort that yes, what kind of controls you have to devise or you have to test. Devise, definitely management has to devise, but you have to test. You need not to test all the controls. You have to test the controls which is impacting your financial statements or the financial reporting. Maybe in previous year, what kind of deficiencies you have communicated to the management, so you will pay more attention whether that has been rectified or not rectified. So all you have to understand the structure. This is at the top level. Now you are not discussing at the assertion level, you are discussing at the top level. What is the financial structure, whether it is highly leveraged. Leverage means most of the requirement is coming from the loan or borrowings, then there may be a pressure from the borrowers for interest or DSRA, debt service ratio. So you have to understand, because financial reporting can be falsified because of certain pressures or because of certain incentives. So you need to understand what are the incentives which are being given to the management, whether managing director bonus is linked to the performance of the company, or if there is any pressure from the investors on the management, you just show the top line on a higher side. So you need to understand all those aspects. If you understand, then you can pay more attention to the more risky area. So audit is very, very judgmental. It's not right straightforward, do this and this, and this is not a formula based. This is very, very Judgmental, you need to understand, you have to take a lot of decisions during the process based on your understanding. Now, materiality. Materiality is very, very important word. And what do you mean by materiality? Materiality is meaning thereby on what account balance, on what class of transactions, or on what disclosures you have to perform procedures. You have to do control testing. It's not necessary on all line items of the financial statements. You have to perform the procedures, or you have to perform control testing. For example, share capital. There is no activity in the share capital. There is no additional capital has been issued during this. So it's very, very low risk area. You need not to perform a lot of efforts there. But on revenue, last year revenue was 100 crore. This year 200 crore. Double digit means the revenue is double. It means you need to pay more attention on the revenue activity. So it is material. Same materiality meaning when you are performing the procedures in with respect to substantive procedures as well as for control testing or for identifying the items or the line items of the FS financial statement, you use same materiality which you will use for audit of financial statements. So this is a requirement, and it should not be like you're taking a different materiality for identification of the accounting balance or class of transactions for ICFR audit, and different materiality for audit of financial statement. You have to use same materiality. That's why it is an integrated audit, because ultimately you have to give the opinion on the ICFR as well as on statement. So you have to use same materiality. You have to do, you are working in tandem, because whatever are the results of your ICFR, same results you can leverage. Not can, you should leverage, and you must leverage in the audit. Otherwise you will end up in doing over audit also if you're not leveraging that results. So if your control testing is effective, controls are adequate, definitely the amount of substantive procedures will reduce significantly. We will devote some time on this slide, and this is the crux. This is the crux of the entire presentation and the entire ICFR note, guidance note. So on each item we will discuss, and then we will move. As we know that there are means entire audit has been divided into 4 parts for the 4 steps. First is the planning, then design and implementation, operating effectiveness, and reporting. So whenever we do certain work, be it audit or be it maybe wedding or any, or you want to buy a house, you want to buy a car, so you do certain planning, then you implement. So these, if you just correlate these 4 steps, you will be able to correlate it with your real life examples also, real life activity also. So now coming back to this ICFR, then planning, what we exactly do in planning. So identify, this is the starting point. If you correlate that presentation, that pictorial diagram, that was financial statement, there is assertions, then there was misstatement. If you correlate that will, you will find in this diagram as well. So first, what you will do at the financial statement level, you will identify significant account. Now this is the actual way of working, how we do audit of control, audit of ICFR. So first of all, we take the financial statement. Now the question may come, we are doing interim audit, how you will get the financial statement? It's a valid question. How you will get the balance sheet at December? So basically what you can do, either you will request the management to provide an interim financial statement based on 9 months period, or at least as a starting point, you can take the financial statements of the previous year just to identify the significant account. But again, if you're not getting the interim balance sheet, you may have to work additionally, because there may be certain new items also. So on that, you will have to perform procedures again specifically on those new items. So you, in nutshells, to summarize, you can demand the interim financial statements from the management. Based on that, you can identify the significant account balances and significant disclosures. What do you mean by significant? Account balance. What do you mean by account balance? Account balance means accounts payable, accounts receivable, property, plant and equipment, share capital, class and class of transaction. Second is identifying and understand class of transaction. What is class of transaction? Revenue, expenses, class of transactions. So you identify that. But which line item or which class of transaction or account balance which is significant? How you will identify significant? How you will select which one is significant? Apply materiality. How you will calculate materiality? Again, judgment. But yes, I give you the practical view on this. It's a 320-page IC guidance note. Everybody, you can go back and read that. But here we will talk about all practicalities. I will try how practically it is done, how practically ICFR audit is done. There is a lot of literature. Even you will spend 10 years, you will not be able to complete the literature. Huge literature is there even at the institute site. Huge literature is there to read. The life will end, but the literature will not end. So definitely that guidance note is there. You can go back and read. But here we will discuss how practically it is done. Okay. You will get financial statement. You will identify accounts. But which accounts? Significant accounts. How you will identify significant accounts? Based on materiality. How you will decide materiality? Okay, now talk about some practicality. What is materiality actually? Why we are identifying materiality? It is very important word. We are auditing financial statements. For whom? For the users of the financial statement. Or you can say there are various users, but let's talk about investor as of now. Who has invested money in the financial statement, in the business? They are the foremost users of the financial statements. What they want to do? So how they see the business? If the intention of the management, if the intention of the users is to promote the top line means revenue. It's not a straightforward answer how to identify materiality. Yes, I will come to that. But how you will decide what is the basis? Because materiality is a number that you will get by applying certain percentage of certain items. But which item, what percentage, how? So we have to go back to the users of the financial statement. How the users see the financial statement, what exactly they see. If users have intention to see the top line, suppose startup companies, the intention of the investors is to increase the top line. It means revenue is the important item. So you should compute your materiality on revenue. But it is very established company. It is very established company. Now investors want to see the profit. How profit is there? I want to earn the maximum profit. So the maybe auditor can go for profit before tax as the starting point. If company is capital intensive, investor want to invest more and more first, you can go the asset base. There are various ways. So let's discuss revenue and profit. So if intention is to grow top line, start with sales. Intention to see profit, start with PBT. Now what is the percentage? Or if there is a loss, because in the setup phase generally that's why the investors are on the top line. If there is a loss, then you can go to the top line again. So basically now what is the percentage? Percentage is nowhere defined. Again, it's a judgment. But you can draw certain analogy from Schedule 3 to Companies Act 2013. What Schedule 3 says? Somewhere something is written. It says if any item is more than 1% of your turnover, you should disclose it separately. What they are trying to say, 1% is important amount, 1% is significant amount. That's why they have said 1%. So you can take that. Let's say if you can justify, if NAFRA comes and says why you have taken 1%, because it says something. If you take 5.5%, again somebody will ask. If you take 1%, somebody will ask. So take something which you can say I have taken from that. I have taken from somewhere which is written over there. So you can take 1% of revenue, or you can take 1.5% of revenue. But it is giving you certain directional things. Okay. Again, further factors will come up. If it is a new company, there is higher challenges. So taking a 1%, because in audit, as you know, we are doing a risk based audit. Risk based audit means you are not verifying everything. You are picking something and doing you are doing your audit procedures and giving opinion. That is risk based audit. Where there is a higher risk, perform audit on that area, means significant items. So there is always a detection risk. There is a word detection, means you will not be able to identify all the risk, or you will not be able to mitigate. Basically, you will not be able to mitigate all the risk. There will be certain mistakes which will remain over there. This is assumed. It's may or may not, but it is assumed that some mistakes will be there. But you can, by performing audit, be it ICFR or statement audit, financial statement, you cannot reduce it to zero. Risk cannot be reduced to zero. By doing all these procedures, you are trying to minimize, you are trying to bring it at an acceptable level. And what is that acceptable level? That is a materiality. So if something is above materiality, you have to perform procedures. If below materiality, it means it will not impact the users to take decisions. What is material? If it changes the decisions of the users, then it is material. That's why I linked it. Whether you have to base your materiality on revenue, you have to base your materiality on profit before tax, or asset base, or capital, share capital. So you have to see the intention, or what is the expectation of the investors or the users of the financial statement. From that perspective, you have to select the base. Now, for example, I have selected the base as sales. So apply 1%, or this is the top line. This is the highest amount, 1%, because detection risk is there. So you should take something lower than that. You can take 0.5%, you can take 0.75. It's new entity, it's settled entity. In previous year, you have not found any material error. It depends on you. Again, judgment will come up, but you got the some base and some percentage, then you compute a materiality. For example, 1 crore is the 1 crore is the turnover, and I am taking a 5%. What is the 5.5%? Sorry, how much is 1 crore? 5 lakh. 1 crore 50,000. 0.5% is 50,000. So any amount above 50,000 you have to select, means account balance or disclosure or class of transaction which is above that amount. There are additional procedures, additional consideration for significant account, because it is multiplied, it's not balanced. So at least you can just take a base that above 50,000 you will select that item for performing procedure. So for example, revenue was there, purchase was there, inventory was there, accounts receivable was there. On that account, you will identify the related risk. If I talk about purchase, maybe you have not purchased something, purchase order has been created and material has been received, that is a risk. Duplicate payment has been made, that is a risk. You have not made the payment to the correct vendor, that is the risk. So there may be various risks. So you have to identify at assertions level. At assertions level. After identifying risk, then you will identify control which address the risk of material statement. So what is the control? For example, you have made duplicate payment. Maybe the confirmation may be one of the control, or year-end scrutiny or review of the vendor ledger, that may be another control. So you have to see what will address. So you have to identify the controls at risk level. Material misstatement, or the misstatement is risk, what can go wrong, or we can call it what can go wrong. So what thing can go wrong, that is my risk. To address that risk, I need to have a control. Okay, I have identified the control, I have identified the risk, but it is not running in isolation. There are a lot of applications, IT system is there, under which all transactions are happening, recording is happening, processing is happening. So you have to identify what is the IT application, what is the IT environment. We will discuss in detail on IT environment and IT application, but you have to identify that as well. So once you have identified all this, so planning part is done. Now you have identified risk, you have identified control. Now you have to perform procedures. Now you have to give the opinion on adequacy, first part. Second, operating effectiveness. So now how you will identify the adequacy, assess the design of the control. So by assessing the design and assess the implementation of the control, so design will come for the adequacy. If it is appropriately designed, it is adequate. If in sufficient number, yes, it is adequate, right? So how you will verify this? This is called walkthrough. You said to the management, okay, these risks can happen. Management will say, okay, this is the control. There may be a duplicate payment, we get the confirmation, we do scrutiny. This balance does not exist, we get the confirmation. Your purchase is not overstated or sales is not overstated, we do cut off procedures. This is the control. So this is management is telling and you are hearing. So how you will verify actually it is happening, whether control is in existence or not? You will do a walkthrough. What is walkthrough? You will pick up one sample, you will verify that whatever is management is saying, whether that control actually exists or not, whether that is happening or not. Risk is there, risk you have identified, but whether that control mitigating the risk or not. So you will take one sample, one transaction, you will verify each and from initiation till end, means initiation, authorization, processing, recording, reporting, everything end to end. You will verify that one transaction if it is working effectively. So you can say design is effective, means what management is saying. So design is there, but now design and implementation. So control is there, that is implemented, you have verified through walkthrough. So appropriately designed. So if that is there, if you say walkthrough is fine, control is there, then you will go for operating testing. Now you will say, okay, control is there, now I will increase the sample size. And there is a even in the guidance note it is given how many samples you have to verify. So in case of transactions happening on a daily basis, so minimum 25, maximum 40 transactions you can verify. So it is given that statistics or the number, how many samples you have to test, that is given. I will show you in the presentation also. So now you will select, for example, sales. You will take the entire sales register, and out of that you will select 25 transaction, for example. Now which 25 transaction? So that is called sampling. It may be haphazard, it may be random, maybe block. There are various ways. So how I will do personally. I will say whatever is the population divided by 25, whatever is the result, every that means incomplete, don't full in comma or in full stop. So all integers you can take. So every that transactions, for example, I have 100 line item or 100 sales transaction, I have to check, for example, so it's very I have to test 25 transactions. So every fourth transaction I will check. So 25 transaction I will pick up. Okay, so that way you can select the transaction which you have to verify. So now important word is nature, timing and extent. What is nature? Nature means nature of the procedure. It may be inquiry, it may be observation, it may be reperformance, it may be verification. These are the nature of procedure. Timing, when you will perform, at interim date, at year end date. This is called timing. Extent means quantity, how many, to what extent. 25% of materiality, 100% of materiality, 10% of materiality, to what extent, or 25, 10, how you want to test it. So extent means in terms of quantity, timing means when you will perform the procedure, nature means type of procedure. So you have to decide that, and you have to select the samples to perform. Then you will actually perform the control testing, assess the results, means if they are working fine, if there is a deficiency, you will assimilate that. One template is called summary of control deficiency. You accumulate all the deficiency, assess is whether it is pervasive, means your deficiency is impacting the entire financial statement. It may become material weakness, If it is not impacting, it is very, very specific. It may be significant deficiency. If it is not impacting, it's very less impactful deficiency. So it is a simple deficiency. So you accordingly you can decide whether your opinion will be qualified, non-qualified, disclaimer, whatever is the possibility. Accordingly, you will decide, and at the end, you will see whatever results are there for the testing, whether it is impacting your audit opinion or not, and accordingly, then you will issue your audit opinion on the financial statements. It's not necessary if there is a material weakness or you are issuing a qualified opinion, then this audit opinion will be qualified. It's not necessary, because if you have identified certain failure in the system, you corrected it. If you corrected it, then the figures in the financial statements are correct, then you will not qualify your financial statement opinion. Okay, I hope you understood this. Now we will move a little bit faster, because I have explained the entire process in this slide, and I hope you understood that. So now controls may be operational control, financial controls, and compliance control. These two type of controls auditor verify, but this is effectiveness and efficiency, as I have explained that this is kind of a operational but management has to perform this, and especially listed company has to do the independent testing also on this. Let's take an example. What is operational control, what is financial control, and what is compliance control? So operational, vendor selection process, purchase requisition, quotation analysis, purchase process ordering. These are the operational. When by vendor selection, it is not directly impacting your financial statement, because no transaction has happened. You are just selecting the vendor. But to selecting the best vendor, operationally it is important for the management. Selecting the vendor which is providing the goods at a lowest cost is operational, right? So these are the operational things. This is the operational process. Financial, purchase order. Now, once any transaction has been initiated, it comes into the system. Now, from that point in time, starts financial. Once purchase order has been created, it has financial impact. Creation of vendor master, goods receiving process, bill verification, payment, vendor ledger accounting, all this is having impact on your financial reporting. Then there may be a compliance, whether you have taken correct input tax credit, you have deducted tax, you have done the related party disclosure, MSME disclosure, or other disclosure like segment and financial management disclosure. So a whole lot of disclosures are there. So this you have to ensure as an auditor during the audit of ICFR. So this is scoping, means how you will do with this. We have already discussed in the detailed presentations or review financial statements to identify significant account, relevant processes, IT general controls. So this is largely we have covered. So we'll not devote much time on this part now. Now coming to the top-down approach. What is top-down approach? Top-down approach has been explained in the guidance note. Again, top-down means you have to start with the financial statement. So at the top, at this level, so at this financial reporting level, financial statement level, you have to obtain financial statement, then you have to go to the assertion level. But at this level also, there are certain controls which you have to ensure. That is called entity level control. That is called ELC, entity level. Entity level control means at the top of the control, like there is a effective oversight by the audit committee. Board is reviewing the monthly accounts. Internal audit system is there in the company. Company is well balanced in terms of capital financing. Company has secured IT environment. So it may impact your TLC. TLC means transaction level control, or it may not, but it will set the tone at the top. We will understand this also aspect. So these are the entity level, means what is covered in entity level control. Tone at the top. What is the philosophy we have already discussed when we were talking about 5-step model of the control environment. So tone at the top, key decision making, what is the code of conduct, what is the whistleblower policy, risk management policy, MIS, HR policy, these all comes in the entity level control. Internal control system is there or not, obtaining that management or the internal auditor is presenting internal audit report in the audit committee or in the board meetings. So these are all entity level controls. Maybe it is not impacting directly your TLC, so it may or may not. For example, let's give you example. If company is comparing the financial results with the budget, if management is comparing the financial actual results with the budget, it is not directly impacting your TLC or assertion. But if management is comparing or analyzing budget of lease rentals with the actual, now it will impact, because management has expected that this should be the lease rental. They know what is the lease rental in the previous year. There is no significant expansion in the next year. So they can say this should be the my lease expense. So if they are comparing it, it may impact your assertion level. So that's why it may or may not. So, but it is very, very important that entity level control is very important because it sets the tone at the top. If entity level are goods, effective control is there, you can assume, at least it's not necessary, but you can assume that under that you will find an effective environment, or controls may be working effectively. Now coming to the review of IT general control. So this is again at the top, entity level control and review of IT general control. What is review of IT? What is IT general control? Information technology controls. As you know, in today's time, you are working in a highly technical environment. All things are happening automatically. If we talk about a reasonable size of organization, things are working on an automated mode. You place the purchase order. Once you receive the goods, GRN is prepared. Automatically that will be approved, means by the users. Automatically on their systems, the approval will go to the user department. Then after user approves it, it will go to the finance department for payment. So lot of things happening in the black box. We call it a black box. I don't know, if you're technical or you're competent enough, then it's good, but it's not necessary that all the chartered accountants are good enough in the technology as well. So it's not, even if you are not technically competent, you can take the help of experts. That's again, there is a separate auditing standard on that. You can take the use of external expert as a part of audit. That is allowed if you, but ultimately because ownership is yours, you are giving the opinion on the financial statement. If something goes wrong, you will be behind the bar, considering the current scenario. So be very, very careful. If something, there is particular area on which you don't have good hands, please take the help of the external expert. Like in the similar way, management also takes. If management is not good enough in something, they take the external help. For example, actuary. If I have to make a provision of gratuity or leave encashment, I take the help of actuary. Management take the help of actuary. They compute, they discuss assumptions with the management, they compute the liability, they record it. But the important part, if management is taking the use of, management is using external expert, you need to ensure that the competency of the expert, whether the actuary is competent to perform the actuary function or not, or if there is any impairment, the whosoever is valuing the projections, or calculating the valuation or computing the valuation of the company for impairment testing, you need to assess the competence of the expert. So that is part of the, again, control or the audit procedure. Okay, coming back to the IT review. So it may be automated. So basically, generally, these are the automated controls and automated accounting procedures, right? It may be automated or it may be system dependent manual controls, meaning thereby system fully automated, or maybe some portion is automated and then you get the some report and you perform certain procedures, and then reliance on the data, because every data you are getting from the system, whether that is coming correctly, not correctly. I give you an example. If you do not test it, I put a program in the system. Whenever you are booking a purchase, please add 5% on that. I can design it in the system. Whenever purchase is being booked, please increase the rate by 5%. Standard program setting. So whatever sale is or purchase is being booked, that is inflated by 5%. Then it is the same payment is going to the party, and there is a collusion. So you can commit a fraud. So from that perspective, just I am giving a hint, or I'm just giving you an example. Fraud can happen in many ways. It may be intentional, it may be unintentional. If it is intentional, it is fraud. If it is not intentional, it is error. So it may be error or it may be a fraud. But you need to verify IT general control if you are relying on the automated controls and you are getting a lot of data from the reports like aging, AR aging, AP aging, you are getting from the system. How do you know that aging has been correctly computed, data range? We will discuss IP. Then I will discuss in detail about this. But there is a possibility something can go wrong, and you need to assess this IT environment. And this is nothing but the IT general controls at the overall level, like we discussed about philosophy and entity level control. In the similar way, what is the overall environment under which the applications are working? For example, SAP is there. So SAP is running on a platform, but there is a server, there is a backup plan, there is a access program, there is a change program. Various things are there. So these are the 5 things mainly which comes in the IT environment. So IT governance means what is the overall, what is the backup plan, what is disaster recovery plan? If something goes wrong, how the management will be able to recover the data? Whether this is being stored at the third location or outside the office or inside the office, whether it is on cloud or it is on the internal server only. Access program means whether anybody can access and change the program. Is there any restriction? Change management, can anybody can change the logic in the program? Program development, new programming is coming directly, it is going on the production server, or it is being tested, then it is going on the production server. So basically, if we talk about in layman terms, what is the access control, what is the change program? Access means who have the access to change the things in the system. Change management, who has the access to change the program. So if that is effective, in the similar way, you will identify the misstatement or the risk. Then you will identify the controls. You have to test those controls. If that is effective, then you can say, okay, like I take the example of house. If my house is sound, proof, so I can safely stay there. So I can rely that nothing is going to happen, even if earthquake is there. So in the similar way, if my IT environment is safe, it is working effectively, I can say the application is working under this. Whatever data I am getting out of it, I can rely on that. So this is IT general controls. What is business process? Now we are diving at the assertion level. That is called TLC, transaction level control. So what may be the transaction level control? Revenue. For example, we talk about revenue. What may be the error? If I go to statement assertion level, it is accuracy. Maybe your revenue is not accurate. What is the risk? Maybe incorrect price. That is the risk. Incorrect price has been picked up. So these kind of risk may be there. Transaction not recorded, transaction recorded in duplicate, transaction recorded in the wrong period, incorrect price used, incorrect quantity used. So these all are the misstatements that can happen. So now linking with the previous slide. So revenue, accuracy, assertion level, risk, incorrect price. What is the sub process? So if you seen that top down approach, then from financial statement, there may be a sub process also, means invoicing process. So in revenue, there may be a various sub processes. This is a process one, revenue. And under revenue, how many process? Ordering, shipping, invoicing, cash receipts, adjustments. These are the sub process. So from sub process, that is invoicing, there may be error from there. So from invoicing, there may be a. So once you want to check the invoicing, so you have to check the invoice control, how the price is going in the invoice. That is called control activity, basically a control. So for this risk for incorrect price, what is the invoice control? And why we are doing IT testing? Because IT has the implication. Maybe why price is wrong? Maybe some unauthorized person have changed the price. So this is the control, but somebody has changed it. Access to the program and data is not restricted. Automated controls are not properly designed. So you have to do the IT control testing, and whether only authorized person is only authorized persons are there to change the program. And when you are doing a IT control testing, you have to see how many programs have been changed during the period, who are the authorized persons, what testing has been done, if somebody has changed the program, whether that has been tested or not by the users. So these all are the activities which you have to see at the IT level, because ultimately now if we talk about today's scenario, a lot of things are happening on online or in IT highly technical environment. So risk may arise from here. If you are sure that this is working fine, then definitely you can rely on these things. So whatever is happening in this process. Okay. So these are the various business process where revenue, receivable, purchase, inventory, fixed assets, payroll. These all are the processes. So there may be certain sub processes. These are the sub processes for revenue. Order management means you will receive the order, then you will put in the system, then shipping will happen, then there may be a receivable, cash management. So these may be the sub processes for revenue. These may be sub processes for purchases. Purchase. Suppose if you are a trading company, you will purchase and you will have the inventory. That's it. If you are a manufacturing company, you will purchase the raw material, you will manufacture it, and that is a bill of material, that is called BOM. From BOM, you will produce the inventory, and at the end, that will go to inventory. So these are maybe the sub processes or business cycles of inventory. And at the end, there is a general ledger which integrates all the processes. So payables will come in GL, assets, payroll, receivable, cash management, everything will come into general ledger. Okay. So now we have discussed the different things, automated controls, ELC. So basically now let's discuss about design. Though we have discussed earlier also when we were discussing that the bird eye view or the total map, how the design testing of design is to be done. So again, if you see this picture or the diagram, so it's a financial statement level risk. Okay. So we are starting at the top, you are getting the financials. So there may be assertions. You have to identify assertions. Then you have to identify material misstatement at that level. So assertions, what can go wrong is just a misstatements that can happen at this level. And if it is significant, you will design your audit procedure accordingly. If it is not, respond the risk accordingly. Suppose there is a risk of overstatement, get the confirmation or do ledger scrutiny, whatever procedures you have designed. So this is how you have to design. Ultimately, you will pick up the transaction and you will do the walkthrough from initiation till, and that is how you will identify the design is effective. And this we have already discussed in detail when we were discussing that chart. Okay. Now risk assessment, understanding the business process, identifying risk in the business. That we have risk assessment means at entity level, again entity level control or misstatements you have to identify. But key controls are controls that effectively address the risk identified in the financial reporting. It can be ELC and it can be TLC. And in detail, each and every item we have discussed in previous slides. So we will not devote much time again on this risk assessment we have done in earlier slide. Now testing. Testing is again important. We discussed about nature, timing, and extent. This is very, very important. You have identified the risk. You have ensured that controls are there, adequacy is there, that you have performed, you have tested through walkthrough. Now what you have to do? You have to design your procedure. What procedure? What you will do? Whether you will do inquiry, you will do reperformance, you will verify the document, or you will observe. Let's take an example. Inventory count. You will do inquiry or observation or reperformance. Basically, you will observe whatever written instructions are there, how the management is doing the inventory. So you can observe that. So that is one of the procedure. Verification, title deeds, whether fixed assets are in the name of the company. What you will do? You will do verification. You will verify the title deeds, whether it is in the name of the company. So audit procedure is verification of the underlying document. Okay. Inquiry. Okay. Roll forward procedure we discussed earlier. When you are doing certain testing at interim date, you were performing roll forward procedure. That time, suppose there is a remaining period is 3. You will inquire whether with the management, whether there is a change in the system. No. Is there any new risk? No. Or yes, whatever is the answer. Or there is any new system? Any new product has been launched? So these are the inquiry procedure. But in nutshell, only inquiry procedures will not be suffice. With inquiry, there may be certain additional procedures which should be added to get the comfort on the operating effectiveness of the control. So basically, this is what the nature, timing, and extent. How many controls we have to test? So let's discuss. This is the thing which is already given in the guidance note. In case the control is happening at the annual level, so what maybe that control level? Review of financial statement. So definitely financial statement is being prepared at the year end, so there is only one control, so you will test that. Quarterly, you have to test 2 controls, means 2 quarter you have to verify. It may be what? It may be quarterly internal audit, it may be quarterly bank reconciliations, whatever, or quarterly stock take. It may be anything, whatever controls are there which management has set, you have to verify that. 1 plus 1 means at the year end, plus 1 last quarter, means January to March. If we talk about current 23-24, so March quarter, Jan to March 24, that is the last quarter that you have to verify. But remaining 3 out of 3 you can verify 1. Okay. If it is a monthly control, bank reconciliation may be monthly, stock take can be monthly, external confirmation can be monthly, whatever review, MIS review can be monthly. So there may be various controls which can be on monthly basis. So if it is a monthly control, then you have to verify minimum 2 and maximum 3. And in this 3, please, and maybe you can just again judgment, you can take 1 period and also. If it is a weekly control, minimum 5, higher side 8. If it is a daily control, you can take 15 on a lower side and 25 on a higher side. Okay. If recurring manual controls multiple times, so if, for example, sales happening on a multiple times on a daily basis, so minimum 25, maximum 40 on a higher side. But if you find any error in one of the control, if you identify any deficiency, you can increase the size. It's not the maximum, basically. It's a normal scenario. If you have identified anyone's deficiency, you can select additional 15. It depends. Okay, so this frequency is for manual controls. What about automated controls? For example, 3-way match is happening automatically in the system, or aging is being prepared, or payment is being happening on a real time basis. So there may be various automated controls. So how many times you will verify automated controls? Suppose it's a sales, you will verify 25 times or 40 times? No, you will check only one sample. You will check only one sample if it is a automated control. Why one? Because it depends on the logic. If logic is correct, your program is correct, it will give the same result. You test 1, you test 1000, you test 1 lakh, it will give same result. That's why if it is an automated control, you check 1, but if it is a manual control, this is the table for manual control. Another thing, for example, your IT general controls are not effective. You are saying there is no access control, anybody can go and change. So can you say the automated controls are working effectively? Answer is no. If overall structure is not good, overall environment is not good, so under that environment, whatever activities are happening, you may not rely. It may be right or wrong, but you will not rely on that. So what you will do? If you will not rely, does this mean things are not there? No. Then you will not test 1, you will again test, you treat it as a manual. You test 25 and 40 again in the similar fashion if your IT general controls are not effective. So again, if I summarize this, please leverage the IT controls. If your IT controls are, if your IT environment is effective, you can rely on IT application control. IT application means automated control, and automated controls are tested only one. Significant work, significant time will be saved, and you will have to perform very little other manual controls. So IT environment is very, very important. So if you want to rely on application controls, please do test the IT general control. Okay. During this verification, during the testing, you came across certain deficiencies. Control is not working properly. I give you one example. Management is getting confirmations on a quarterly basis from the third party, external confirmation. It's not necessary the management or even you as an auditor also circulate the confirmation. Is it not necessary you will get the confirmation from the third party? But what if you are not getting the confirmation, the control is failure? No. Then perform alternative control. What is alternative control? Let's take an example again, accounts receivable balance. If you are not getting external confirmation, do some alternative procedures. What is alternative procedures? Whatever is the composition, or okay, there may be a subsequent receipt checking. Today, maybe that amount has been received. If answer is yes, then you can treat that balance was correct. If not, what is the next procedure? You can do the built up. That is called built up, means how that amount has been built up. Means there may be certain open item you obtain, you get the open item listing through which that amount has been created. So verify that invoices are correct, goods has gone out of the factory, means you verify the gate entry, goods outward pass. So there are various compensating things which you can perform. It's not like if you have identified certain deficiency in the system, you will qualify, or you will say you will not rely on the controls. But if even there is no compensating control, there is no alternative to verify that, but definitely then you will have to take the decision. Accordingly, you have to design your audit report. It may be significant deficiency, or it may be material weakness. If it is a material weakness, it may be adverse report, or it may be a qualified report. Okay. Now, very, very important part. So largely we have covered that designing and operating part. But what is IP? IP is information produced by entity. Very, very important term. What is IP? You are getting aging, AP aging, AR aging, inventory listing. What is this? This is all IP. IP can be used by management, and IP can be used by auditor also. It is a system generated reports. It is a system generated reports. If your IT environment, IT general controls are effective, it give you comforting position that at least you can rely on IP. But again, you have to perform certain additional procedure to rely on the IP. But let me practically tell you, I don't think so. We are testing IP. And believe me, it's a very, very risky area. Management is giving us a report. We are relying, okay, number is matching. This is coming in here. It is coming here. Okay, it's good. Work is done. No, please verify how report has been generated, what parameters has been given, what is the source data. Parameter means what is the accounting range which has been given while extracting this report. What is the logic? Logic means the aging has been extracted from the invoice date or from the due date as a disclosure that will go to the on the due date basis. But maybe the report has been generated on invoice date basis. Yes, for management, if management want to use it for credit management purpose, they can get it on a invoice date basis. But as an auditor, for making provision, for ensuring provision is correct and disclosure is correct, you have to get it from the due date. Source data from which tables from the system has been used. That source data, whether it has been taken directly from the production server or there is a separate customized report data has been extracted from there. Certain codes has been left, means for example there are 4 types of codes or source code from where AR is generated, but only 3 codes has been picked up for AP generation. So basically we have to check the accuracy and completeness of the report. Once you are getting the report, please match the total of the aging is matching with the general ledger balance. How many vendors are coming therein and how many vendors are actually coming in the system. Control check, lot of checks are there. So in nutshell, you have to check the completeness and accuracy of the IP, means whatever report you are getting from the system. Understood? But very, very important, this IP part, and you should ensure this while conducting your audit. So if I summarize whatever we have done, and especially the audit of ICFR, what you have to do, you have to get the balance sheet or the financial statement, identify significant account, understand the process, compute the materiality. Based on that, definitely you will identify significant account, identify the assertions, and based on assertions identify risk, and based on risk please identify the controls, then identify application and related ITGCs, then perform the walkthrough, then perform actual testing. Based on actual testing, see if there is a deficiency, whether you want to issue want means based on the underlying documentation and results of the testing. It will be a modified report, it will not be a modified report. Accordingly, you have to issue the report to the management. Crux of the matter is materiality is the key and auditor's judgment is the ultimate. And this materiality word is very, very important. Again, as we know, as a small practitioners, we are underpaid. We are not being paid fully for our work. So we have to effectively conduct our audit so that at least we can minimize the efforts. If we effectively leverage our ICFR testing in the audit, because definitely we should use, but practically we are doing or not, it's a question. But if you use it effectively, you can reduce your substantive audit procedures significantly, and that way you can reduce the efforts and maybe you can work out there and accordingly. But definitely that is not the substitute. If you are getting a low fees, you will not perform the audit. It is a mandatory requirement. You decide before taking the audit, accepting the audit, whether you will be able to perform it within the given level of fees. But once you have accepted, there is no leeway, means you are whether lower paid, higher paid, or not paid, whatever is the reason. But that cannot be the criteria. If your fees is not sufficient, you will reduce the procedure. Ultimately, sword is on your neck, believe me. But if you're doing your job effectively and efficiently and honestly, believe me, there is nothing which can send you behind the bar. Thank you so much. And if you have any questions, I am happy to answer them. Thank you.
Thank you, Amit bhai. Thank you. Thank you. So nice of you. It's a great presentations in such a short span of time. In fact, less than 100 minutes you got it, and you have touched each and every aspects of this topic IFCR. We have some 10 question, if you permit, can ask.
Yes, yes, sure.
Yeah. The one question is, in case of a foreign subsidiary company for which audit is not mandatory, how to report about IFSC in the consolidated audit report of the Indian holding company?
Very good, Vikram bhai. Very, very nice question. If it is a foreign subsidiary, and definitely you have to consolidate it, and it's a holding company. First of all, you have to see whether it is a company in the Companies Act. If answer is no, so directly it is not mandatory for the auditor of that company to report on ICFR. But as an auditor of the holding company, I have to give opinion on the consolidated. So first is you have to give the opinion on the consolidated financial statement, and you have to give the opinion on the ICFR on the consolidated things also. But what if nothing is being happening? So you have to evaluate whether that subsidiary is material, not material. You can, so there is a concept of multi-location scoping. In multi-location scoping, you identify what is the percentage of assets, revenue, profit of that entity in the consolidation. If that is significant, then auditor can ask the independent person or the management to get the control verified and get the report for his reporting purposes. But statutory, it is not mandatory. But for opining on the consolidated financial statement or consolidated ICFR, he can request the management to appoint a separate person who can conduct, or the manage or the statutory auditor of the holding company can perform the procedures as well.
Right.
But it depends again on the materiality or how big that entity is in the overall context of the consolidation.
Main crux is materiality only.
Materiality only,
Yeah.
yes.
The next question is whether Section 8 company is required to get IFSC audit.
It is a company and it is applicable
Okay, great.
until
How
and unless that lower threshold is not met.
Yeah, I can understand. It is not exempted by the circulars.
Yes.
Third one is how we assess the actual internal financial control over financial reporting of unlisted private company.
Unlisted private company.
Yeah.
Okay. First of all, there are dual reporting. Management has to, as a part of their board report, has to state in the financial statement in the board report that whether financial controls are there or not. And the primary responsibility of designing of the control is of the management, not of the auditor. So what
Okay.
management has to design it, and if it is a listed company, they have to audit it, they have to test the effectiveness also, operating effectiveness also. But in case of private company, specific word is not written for operating effectiveness, but adequacy is written. So indirectly you will reach there, but yes, sufficient control should be there, and statutory auditor is required to give the opinion on the adequacy as well as operating effectiveness on the control. It's a mandatory requirement.
Okay, great. The next one is how best to create financial hierarchy for transaction approvals.
How best?
To create
Sorry.
financial hierarchy for transaction approvals.
So it depends on the
Transaction
structure.
approval financial hierarchy.
So, Vikram, there is no straightforward answer. It depends basically on the size of the organization, nature of the organization, whether there is a disaggregate, means segregated or decentralized operations or the centralized operation. So it depends. It means if you're using a SAP environment and at each location SAP environment is there, so you can centrally control. Or if
Yeah.
it is a decentralized, so at the location you can give the approval metrics. So the finance controller of the segment or finance controller of the unit, they will have that power. So it depends on the system to system and the organization to organization.
Okay, great. The next one is, do internal controls over financial reporting include system controls?
Yes, yes. System controls. What do you mean by system controls? Which I understand system controls means maybe automated controls. And we did discussed in detail automated controls is very, very integral and very important part of the control testing. As we know that in today's world, everything is happening on, IT environment. So definitely it is integral part of that.
It is mandatory for unlisted company to test internal controls. Please clarify.
From the auditor's perspective, yes. From the management perspective, they have to see the adequacy only, because if we discuss that the directors have to disclose or explain in the board report that controls are adequate with respect to the financial reporting. So as such, if you go by the literal meaning, the maybe operating testing word has not been used, but how you will test the adequacy? Until and unless you will not test the controls, you will not be able to test whether adequate controls are there or not. Yet
Right.
number may be different. You are testing only 5, or you are testing 25 transactions. So samples may be different for the man. And one more important point here is, even suppose there is a listed company. As an environment of a listed company, the management has to do the operating testing, operating effectiveness test also. They have to perform the testing of the controls. So you cannot, as an auditor, cannot use the same samples for ICPR. It has to be different. It should not be the same.
Right. Under SA 230 documentation, do we purely keep documentation, or can we write the explanation obtained during the course in which we relied upon?
First of all, what is documentation? Documentation is a document which is self-explanatory, meaning thereby, if the person who have actually performed the work is not sitting with a person who has basic knowledge of the financial and can understand what has been done by reading that document, that is a document as such.
Correct.
So basically, if you are performing any procedure, if you have got explanation, definitely you have to write, because if you remember, I discussed nature of the audit procedures or control procedure. This is one nature of procedure was inquiry. If you are doing the inquiry procedure, definitely you are getting the explanations of the management. You have to write it down over. Very,
Yes.
very important and integral. You should write.
Right. The next one is, what is the consequences of ICFR getting qualified? How will the financial statements be interpreted by the investors?
Very, very practical question. Very nice question. So, different answer for different entity. Give you example. If you are a highly leveraged company, means you have taken a lot of borrowings from the bankers, and if you are having a qualified opinion, it may have a severe impact on you, because there is a in the loan documentation there is a debt covenants, financial debt covenants. You have to test that. If you fail that debt covenants, your interest rate increases significant. Maybe going forward you will not be able to get the funding, and if you get the funding, at that will be at a higher interest rate. But if you are a closely held company or a promoter driven company, maybe qualification is there, it does not matter as compared to the highly leveraged company. So qualification has impact, but you have to see what is the objective, who are the users of the financial statement, who is using those reports for what purpose. So it depends on
Yeah. The major change in shareholding can also material while planning the IFSC audit.
100%.
100%. Good. Suppose if we have decided materiality at 1% of turnover, then whether the EQC need to examine and document the basis of materiality.
Yes, if that, so because EQ entity level controls may directly impact. First of all, let me just clarify. Maybe when you are testing the entity level controls, it will not come, the materiality maybe for all ELC, materiality will not come into picture. Suppose you talk about verification of internal audit reports, where you will use the materiality. It's for the overall.
Yeah.
If board is comparing the results of the actual versus budget, there may be the materiality limit. Or if you are comparing the lease rentals with the actual rentals, there may be the materiality. So it depends what kind of controls you are verifying, but to give the answer, it may or may not, depending on the nature of the control.
Right. How SOX reporting is different from ICFR?
Significantly same.
Significantly same. Right. Is risk assessment or TOD is same?
No. Risk assessment and TOD. So basically, risk assessment is the first part.
Yeah.
You have to assess the risk on more risky area. Then you will increase the test of details. On less risky area, you will reduce the test of details. And again, it is test of details is also driven by the control testing. If your controls are effective, TOD will decrease. Test of details will decrease. So it has interlinked. It is interrelated. Means it depends if control environment is effective. So risk assessment is definitely you have to perform. But below that, you are doing the control testing. If control testing is effective, then your TOD will decrease, or vice versa.
Great. This is all we have right now, Amit ji. Now, Anil ji, over to you for vote of thanks.
Thank you so much, sir. Thank you so much, Amit ji, for the wonderful deliberation. You have spoken for complete 2 hours from 4 to 6 without any breaks, sir. Hats off to you. You have covered all the aspects of IFC and related topics. Very, very informative. I have gained a lot through your deliberation. Hope our members have also gained a lot through your deliberation, as well as through your question answer session also, sir. Once again, thank you so much from the core of my heart on behalf of AASB of ICI for sparing your valuable time and sharing your expertise with all our members at this in a very large number. I also thanks to today's moderator of the day, very respected CA Vikram Agarwal ji, for sparing your valuable time and coordinating this webinar in a very efficient manner, and for the question answer session. And thank you so much on behalf of AASB of ICI for your precious time for moderating this webinar. Thank you so much, Vikram ji. Thank you so much, Amit sir, for your precious time and expertise. Thank you so much. Namaste.
I put across my thoughts, and the participants got something out of this session. Thank you so much.
Yes, sir. Yes, sir. Very informative, sir. Thank you so much. Thank you.
Thank you.
Thanks.
Thank you, sir.